Today we are going to talk about a very important aspect of investing in mutual funds. And if you're making your investment without understanding this key feature, then you could be leaving a lot of money on the table. The feature we're going to talk about is the difference between the growth option and IDCW, income distribution and capital withdrawal. We're going to explore both these concepts a lot more in detail. The growth option is nothing but where, like a snowball, the investment builds within itself, growing bigger and bigger because all the profits generated by the fund gets reinvested within the same fund. As a result, the corpus continues to become bigger and bigger and provides a long-term growth for somebody who is not looking at near-term returns but looking at long-term. Since long-term wealth creation depends on compounding, it's a perfect way to create a much larger wealth for yourself over a period of time. So that is about the growth option. The IDCW is like a tree that gives you fruit ever so often. It's an option in which you get regular returns. These returns are basically based on when the fund manager books profit and decides to pay dividend. So its periodic is determined based on the fund manager. But it does come at various points in times during the journey of your investment. It provides you a certain cash flow, especially for people who are senior citizens or elderly who want a certain amount of money coming back from their investments. This is a great option. If you're somebody who is also wanting a very passive asset allocation strategy, which means your overall investment in equities can be there, but a certain amount that gets paid out to you as dividend or this IDCW will ensure that that much of money doesn't go back into equity. So therefore, it's a better option for people of that nature. So it is an option that works well for people who desire a certain amount of payout that happens to them. So that is the magic of IDCW. But what is IDCW? I used to think it was called dividend. Now that's where we want to clarify. In case of a company that declares a dividend, the dividend is paid out of the profit after tax of that company. Therefore, that amount comes to you as a dividend payout, and that's what we call as a dividend. In the case of a mutual fund, the mutual fund pays a certain portion of the value of the fund. So it combines capital as well as returns, and therefore it cannot be strictly called a dividend. It is therefore called an income distribution and not a dividend. As far as these two options are concerned, let's look at how they play under different circumstances. So let's say you are somebody who is looking at different aspects of investing from a growth perspective. How does a growth fund and an IDCW option work when you're looking at long-term growth? Obviously, because the money gets reinvested into the same fund and grows much better. If you take a very long-term, say 5-year, 10-year, significantly the growth option will give you a much better corpus than an IDCW, which kind of periodically gives you back money in the form of payouts from the fund. Second, from a liquidity perspective, the growth option does not provide you liquidity unless you go withdraw the money, whereas IDCW, by nature of the fund manager generating a certain profit and then paying it out, you will have a certain amount of liquidity that comes to you periodically. So the second option is far more attractive for people who want to have a liquidity from these options. From a risk perspective, because more money is kept invested in the growth option, the risk is slightly higher. On the IDCW, because there is periodic payout of the money, the fund is expected to be far more stable. Next, from a taxation perspective, especially if you take an equity fund into play, when you are investing in a growth option, you are left with looking after the capital gains. At some point in time when you withdraw the money, you are looking at the capital gain implications. Currently, the capital gains is, if it is less than 365 days, it is 20%. If it is more than 365 days, it's 12.5%, beyond 1.25 lakhs per annum. So these are the capital gains rates on the gains that you make on these funds. But on IDCW, the taxation is completely different. It gets added to your overall tax slab. And if you are a person on a 30% tax slab, you will pay 30% tax. And if you are somebody who is on a 20% tax slab, you will pay 20%. And more importantly, if the total amount paid to you is more than 5,000, there will also be TDS deducted on your investment. So the taxation is quite high if you choose the IDCW as compared to the growth option. So if your option is to build long-term wealth, create an estate for yourself, want a better tax efficiency, then clearly growth is where you need to look at. On the contrary, if you're somebody who is in the stage where you need returns to sustain yourself, you're retired, you are a senior citizen, you've invested for this time when you need to draw money, then an IDCW is a great option. You will get the money back to you at periodic intervals, and these will be from the profits of the fund. Therefore, you are kind of making sure the fund is working for you. It will also meet your specific fund requirements. However, having said and spoken about both these differences, there is a third option, one which you can combine the growth and a certain amount of liquidity, which we call the systematic withdrawal plan, which is what the investor controls by defining a certain withdrawal on a month-on-month basis or a quarterly basis or an annual basis. You can get the benefit of the growth option as well as the benefit of a IDCW option. We have an exclusive video that we have created for systematic withdrawal plan. The link is below. So do visit that video to know more about the systematic withdrawal plan, which will combine the benefits of both the growth option as well as a periodic payout.